And none of us know what we don't know. I didn't know this when I got into this. I had no idea. And it really wasn't relevant to me either. I was like, I don't have a bunch of rental properties. What do I care? Well, I do care. When you actually look at the amount, because there's something else under the Tax Cut and Jobs Act, that's that TCJA, you can write off 100% of your 5, 7, and 15-year property in 1 year. In other words, I could just say, you know what? I know that carpet that I put in for 15 grand, I know I'm supposed to spread it out over 5 years, and most people spread it out over 27.5 years, but I'm going to write it off in 1 year. I'm going to take a $15,000 deduction. Okay, you're allowed to do that. How about all the cabinets? Yeah, you can do that too. How about the fence? Yep. What if it's all financed? What if it's all in a loan? Doesn't matter. I get to take that as a deduction this year if I want it. What if I have a property that I didn't do on this? I've had the property for 3 or 4 years and I didn't know this existed. Then you can change your accounting methodology and you could take that deduction now. We deal with this every year. It's the same thing. It's always crazy. And I see that. The other thing that what I'm seeing, and we'll go over this a little bit more, we'll get into some actual numbers, is the CPA doesn't group activities. Now, let's say that you're a doctor and you have your own office building and you rent to yourself, or you own the building, or you own a structure where you lease, and you're the tenant, or you're one of the major tenants. Do you know that you could group that with your practice? And so let's say your practice makes $500,000 a year and that building would kick off a $150,000 loss. You could group those two together. You're allowed to do that. You can also group similar activities together. It's like I could group all my rental activities as one activity. And that way, if I can qualify as a real estate professional, which you guys will learn about here in a little bit, if I'm a real estate professional, then I don't care whether I have syndications, rentals that I manage, rentals in other states that I don't manage. I can treat them as one activity and treat them all as one. Lots and lots of fun ideas some people are getting, I'm sure. The other thing I see is the wrong entity, and I'll show you just dollars and cents. Will the 100% Tax Cut and Jobs Act bonus depreciation be active next year? It goes to 80% in 2023. We'll see. We'll see what happens, whether Congress gets smart and says, hey, you know what, we need to keep the real estate market hot. We will see. Wrong entity. Just like I was showing you guys in the sole proprietorship, more often than not, that's where the accountants go. That's where H&R Block goes. That's where most people online go. It's just be a sole proprietor. It's so much easier. It's so much easier to pay taxes. It's so much easier to get audited, and it's so much easier to lose that audit. That's what I always say. It's easier to do what? Because the rules don't distinguish between sole proprietorships and corporations. You have a requirement to keep records, books and records, period. I don't care whether you're a sole proprietor, a partnership, an S Corp, a C Corp, a nonprofit, it doesn't matter. You have a requirement to keep books and records, period. Anybody that says that corporations have greater formalities than a sole proprietorship, I'm kind of looking at them going, maybe with the state, but definitely not with the federal government. It's identical. They don't care what you are. The requirements is the same. They may tax one of them less, but the requirement's the same. So not only do you pay more tax, but you're under the wrong idea that it's more lenient, and it's not. People get caught with that all the time. And it's annoying because we're always looking at it going, you're just the wrong thing. Somebody did not tell you the right way to be at the beginning. And a lot of people feel like, well, I'm just starting out. I shouldn't, I'm not blah, blah, blah. Get that out of your head. Build the right foundation and then grow from there. You never know. I've seen people go from zero to millions of dollars in 1 year. Like a lot of businesses, funky businesses too. Some stuff that I would never have thought in a million years would have been successful. So that's why I'm not the gatekeeper. I have no idea at this point. I've seen so many crazy ideas do really well. I don't judge it. I'm just like, if it's going to grow and this is what you think it's going to grow to, here's how you set it up. I don't say, well, you're small, don't worry about it. I mean, think about Bill Gates or Warren Buffett or any of these guys. You think they shoestring it? It's not just because they're wealthy. It's because they do it the right way every time, and they usually get good results as a result. It's that whole fake it till you make it. Make sure that you're operating in the way that can be successful, period. And then the success tends to come. Don't do this weird, I'm not worth it, it's just a small thing, start with the presumption that you need to build it right. All right, let's talk about basis and depreciation. So if you're going to be in real estate, and I'm specifically talking about single family residences here, let me get this. I'm talking about long-term holds. So in some commercial, so whether it's residential, et cetera, I need to know how I'm going to depreciate this thing. And I need to know what I can depreciate. So I know that there's this thing called depreciation, but what the heck is it? Would somebody please explain it to me? And here's what it is. If I buy a property, let's say there's land and there's a little house on it. The IRS says you can deduct the cost of the house over time. The land equals no, I cannot depreciate the land because it doesn't lose value. In other words, if I buy a computer, I know that that computer is not going to be worth anything in about 5 years, right? The IRS will say that's 5-year property. You can actually write it off in 1 year under section 179 or 168K, but the IRS says it's 5 years. That's its useful life. The land has an infinite useful life. It's not going away unless you pull stuff out of the land. You start pulling minerals out of it. You start drilling for oil and stuff, and you have depletion. But we're not doing that. We just built a house on it. But you can deduct the cost of the house. The house, the IRS is going to say is going to be this 27 and a half year property if it's residential. And they say the structure. They know the carpet's not going to last 27 and a half years. It'd be nasty. But they require you to break that out. So let's go back to here. Let's say that we have a property that we're going to buy. Let's say we buy it for $500,000. And there's an assessment on the books for $300,000 that has a $60,000 land assessment, which is 20%. I can use that ratio. What's 20% of 500,000? It's 100,000. That's its land value, which means I can deduct $400,000 over a period of years, over some period of time. That's how that works. It doesn't matter whether I financed it. It doesn't matter whether I bought it for cash. I write off the 400,000 over a period of years. So I purchased it for 500. That includes closing costs, legal, anything else. I lump that into my closing costs. So recording fees, surveys, transfer taxes, anything, you're lumping it into your basis. So that is considered your basis. Your land is your land value. And your depreciable basis is the value of the structure that you're going to be writing off. So without getting into half year putting into service and all this funky stuff, I'm just going to say the average yearly depreciation in this example is around $14,500. So it depends on when you buy the property, whether you're using the half year convention or whether you bought it in October. You're not going to get a full year of depreciation. You will get to accelerate your depreciation though into 1 year, but we're spreading out our depreciation over 27 and a half years. But just for my example, I'm going to use 14,500. Your depreciable basis is 400 grand. Your annual yearly depreciation, which is a deduction against any income. So this is where you get your losses. What if it doesn't bring in much rent? What if it's sitting there? That's where you still get to write off 14,500. But let's just say it rents for $4,000 a month. I'll have to get my calculator here. Maybe. Nope. So I already did math. Your net operating income for the year at about this is about 65%. So some of you guys who are real property landlords, you know what I'm saying. It's usually around 65%. You're taking out your insurance, your management fees, your repairs. I put CapEx aside, but it's still cash. But my net operating income, let's just say, is 30,000. I subtract my depreciation, which is 14,500, which means my taxable income that would be at my tax bracket. So it's whatever percentage I'm at is 15,500. Now let's compare this with doing it the way what's called a cost segregation and breaking the 5, 7, and 15-year property out. So this is it without a cost seg. Oops, my depreciation slightly off. So I'm going to put 15,500. So I missed a 500. Yearly depreciation is 14,500. Sorry about that. So it's 15,500 in my example from the previous page. If I did a cost seg, I would have that same 400,000, but I would break it into 5, 7, and 15-year property. On average, I'm going to get about $100,000 of accelerated depreciation. It could be higher, it could be slightly lower, but it's almost always slightly higher. I'm using 25%. It's generally the average, it's around 30%. So I'm going a little bit low for a reason, just to give you guys a conservative idea. You'd still have depreciation of $11,000 during the year. So let's say it still rents for 4,000, still has net operating income of 30. I now have a first year depreciation of $111,000, which creates an $81,000 loss. I no longer have to pay tax on that 15 grand. And I just carry forward into future years that 81,000. So in reality, what this means to me is I'm going to get rents of $30,000 a year. Like, you got to understand this. I have $30,000 in my bank account. I'm going to get that, but I'm not going to pay a tax on it based off of these numbers for a good, gosh, what was that? It was 15, 16. It's probably for 7 or 8 years, maybe 6 years at least, of zero taxes off this property. Isn't that wild? And what we're doing is we're just breaking it out from its structure. This is your, let's just say 27.5 year, or it's 39 year if it's not residential. So if you have a warehouse or something, or an office building, it's going to be a little longer period. But everything else is going to be 5, 7, or 15-year property. And I'm breaking it out. Let me show you an actual report so you get a better feel for what this looks like. When you do this analysis, you look at the year that the property was acquired. Remember, we can make this decision on property that you've held for years. Somebody says, can you carry the loss? Yes, you carry the loss, and the loss gets released when you either dispose of the asset and it becomes ordinary loss, which you can take against any type of income. It's not just against the capital gains on the property, but you'd use it against your other income. That's when it gets released, or when you have other passive income that you can use it against. But you're either carrying it forward or you're using it up. And then if you sell the property, then it's always released. So this is a example where the basis, the depreciable basis, was 1.2 million. Here, let me get a better color for you guys. Was 1.2 million. So it's 1.2 million depreciable basis. So the property itself was probably 1.6 million, but the depreciable basis was 1.2. This is what the study found out. It was 27% was in the categories of 15, 7, and 5-year property, which meant that we had an extra big chunk of money. When I add that up, that's what is that? 324,000 or so in extra depreciation. Whew, right? I could use that, and the tax benefit to the individual was almost 50 grand. That's the tax savings. We had a huge deduction. Tax savings was 50 grand. So then you just say, all right, I have a little elbow grease to do. I have to do a cost seg. We use cost seg authority, but you have to do a cost seg, and then you get this accelerated depreciation. But yeah, I get to make that call. Especially if I'm a real estate professional, I'm doing this for sure. If I'm not, I'm probably doing it because I don't want to pay tax on my rental income. When you recapture, this is where people get the biggest mistake, is they think that because they accelerated depreciation that they have to pay recapture on it. Recapture is when you sell a property. So if I sell a property that I've depreciated, and I should say when I sell a property and I depreciated the 27.5 years, I have to recapture that depreciation at 0 to 25%, depending on what my ordinary bracket is. So it's usually 25%. It's capped, but you have to pay 25%. So if I wrote off a property, let's say I bought a property for 300 grand and 225 of it was its depreciable basis, and I wrote off 200,000 of it before I sold the property, I would have to recognize $200,000 times 25% and pay a tax on that. And then anything above that, I pay long-term gain. And that's going to be at 0, 15, or 20%. So you really want it to be in long-term gain. Now, here's why this is important. Because when I have personal property, if I depreciate that personal property down and its useful life is over, how much recapture do I have? Do you know what the answer is? 0. So if I have a piece of property that's 5 years and it was $200,000, let's say that I have a commercial building and I have a bunch of carpet in it, and I use it for 5 years and it's been depreciated down to nothing, so there's no value, my recapture is 0. This is what it looks like. So this is a sale of a building. This was a commercial building, residential building. So I think it was an apartment complex. Yeah, there we go. Apartment complex. Let's see if I can say the right word. Apartment. There we go. We sold it for a what was that? An $800,000 gain after holding it for 5 years. And they had not cost segged it. So they come to us and they come to Cost Seg Authority. Eric Oliver is the guy I work with over there. And you're looking at it saying, would it make sense to do a cost seg after a sale? Or would it make sense to do this right before a sale? So this was right before a sale. So you can get in there, do your study. And the answer was a resounding absolutely. In this particular case, they saved savings. So this is dollars in their pocket, not a deduction. The dollars in their pocket was $73,159. This is where it gets really nutty. And by the way, you could do this on properties you've already sold. And I do say that you need to have access to the property. So if you sold it to somebody, you could say, hey, can I send an engineer through? I've never had anybody deny that request. They're usually pretty cool. Like, yeah, if you want to have somebody come through, yeah, we have to do a little bit of tax stuff. Okay. What's crazy is when you make a change of accounting method, the actual language in the 3115 is you're changing from an impermissible method to a permissible method. Do you get what I'm saying? You're literally, when you're doing the 27.5 or you're doing the 39 year, you're doing something that's impermissible, but they let you do it. It's weird, but they let you do it, but it's in your best interest to not do it the vast majority of the time. It's just the only question is it worth getting a study done? And a study might be, a couple grand or something. So you might be looking at it going, nah, it might save me 10 grand. It costs me 2. Maybe I'm not doing that. It saves me 20 grand and it costs me 2. I'm definitely doing that. Right? I'm going to make sure. So the reduction technique is step 1 is just get the analysis done. This is free. If you're one of our clients, we'll have them do it for absolute free. If it's worth it, then you get the study done. And if in year 1, we don't have to do any special forms, if in year 2, you do a change of accounting, which is a 3115. If you have a loss, then we look and say whether you qualify under any of these other categories, real estate professional, active, or do we just carry it forward? Carry forward is kind of underutilized, in my opinion. Like a lot of people want all the bang in 1 year and they lower their taxes too low. I'm shooting for the 200,000 to 300,000 mark. Again, I'm not trying to get to 0. So sometimes, like if I'm using bonus depreciation under 168K, and I'm talking to you guys that actually know what I'm talking about, right? Some of you guys are thinking, I'm going to write everything off. No. Let's see whether or not maybe we keep the property as 5-year property. and not accelerate that. Maybe we accelerate the 15-year property and leave the 5 and 7 property and 5 and 7 year property the same. Maybe we don't accelerate any of them, or maybe we accelerate the 5-year property. You don't even have to accelerate the property for 5-year property if you've owned the building for 5 years, because it's automatic, because it's 5-year property and you've owned it for 5 years. You take all the depreciation you haven't taken, you get to take it in the year you make your change of accounting. All this is so much fun when you're doing this with clients, guys. Like, you have no idea how cool it is when somebody is sitting there and you're like, you just saved me 30 grand. Yeah. They're like, that's cool. Yeah, that's cool. We love big chunks, but you know what's even cooler is when somebody that it matters to, you save them $2,500, and they're like, that $2,500 actually means a lot to me. It means I can go on vacation this year. Cool, go on vacation, carry forward. Now the question is whether I can take it and use it against and offset other income, like W-2. Somebody says, am I hearing that I can refile my previous taxes and change the depreciation? Correct? No, not quite. We would have to, you could do a study after the fact. So like, I could still do studies. Even if I sold a property this year, I could still do a study up until I file my taxes next year. But I don't think we can go back and do any sort of I don't think we can do a change of accounting election if we've already filed the return and it's past the extension deadline. So it's not quite that tasty, but we could still look at it. It's something that I've sold in the last last year. I could probably go grab for sure. All right. This is the passive activity loss rule. So whenever you hear about somebody saying, hey, passive losses can't be used to offset other income, okay, this is what they're referring to. It's 469. And then they have a section C7 where it has special rules. This is called real estate pros. So this is when you hear real estate professional status, they're actually referring to these specific rules. And I'll make it really simple. First off, you have to be a real estate professional. So these are the types of businesses you can be in. And by the way, this doesn't have to be for your properties. You could be a real estate professional by doing construction for third parties. As long as you own at least 5% of the company, you're in like Flynn. So it's development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage, trade, or business. Like, you can read, you could see what it is. As long as all of your real estate trades or businesses add up to at least 750 hours, and it's more than 50% of your time. And when I say time, I mean your personal service time, so working time. And I'm specifically saying you, if you're single, if it's a married filing jointly return, only one spouse has to qualify. But you look at all those hours and you add them up. And if you've hit 750 hours and it's more than 50% of your profession. So let's say that I'll give you an example. So I do 800 hours as a real estate agent and I do 400 hours as a school teacher. I would qualify as a real estate professional. Now let's flip that around. Let's say that I did 1,000 hours as a teacher and 800 hours as a realtor. 1,000 hours as a teacher is more time, more than 50% of my time. I no longer qualify as a real estate professional, even though I did 800 hours as a realtor. So you look at it and you say it's got to be more than half your time and at least 750 hours. So in those real estate trades or businesses, none of this has to do with your properties yet. So as long as you're hitting these things, one half, so 50% plus, and 750 hours plus one spouse, then both spouses, get used to determine whether or not you materially participated on your properties. And I'm going to say specifically your rentals. We add them and aggregate them as one group. It's called an aggregation election. And we treat you all as one big group. I'm pretty sure, and in fact, I know that this is in the a specific section on this, and I use a spreadsheet so you can actually add up your hours and I can show you whether or not you qualify, is in the tax toolbox. Like, you can go in there and you can get all this fun stuff. But the material participation test is separate from the real estate professional test. So I am a real estate professional and I materially participate on my properties, and material participation is, there's 7 tests. The most common 3, the only ones that I ever deal with, are I manage everything, nobody else helps. So I self-manage my rentals. I materially participate, I win. Number 2 is I spend, my spouse and I add up our time on managing those properties, and it's more than 100 hours, and nobody else has done more than my time. So if I did 150 hours and somebody else did 140, I materially participated. If I did 110 hours and somebody did 140, I did not. And my 110 hours is the cumulative time between the 2 spouses. The fail-proof test is 500 hours. So if you spend 500 hours on your real estate properties, managing those properties, fixing them, doing repairs, managing, dealing with tenants and all that stuff between 2 spouses. So you each add up your time and your 500 hours. We don't care about anybody else. You materially participated. If it's less than 500 hours, then it's the 100-hour test. You do that and your losses can offset your W-2. So let me give you a real life situation. So I had a client, $800,000 a year as a surgeon. Their spouse was managing their real estate. They had no idea this rule existed. They had no idea that you could do a cost seg. In the very first year they sat there and they said, in 10 minutes, you saved us $183,000. That was their first year tax savings, not deduction, tax savings, because nobody had told them. They'd been accumulating their real estate and they never cost segged it, and they never took accelerated depreciation, and they had no idea that they qualified as a real estate professional. So we cost segged it, we accelerated the depreciation, and we aggregated their rental activities as one activity, so they qualified as a real estate professional, and it saved them in their pocket $183,000. And the total cost of doing that was maybe like less than 10 grand, because they had to get cost seg studies on multiple properties. That's it. And somebody says, do you need to be a real estate professional to take advantage of the 5, 7, and 15 years? No. If you have other rental income, it's a moot point. You don't have to worry. You're just offsetting your other rental income. So like myself and Clint, neither one of us qualifies as a real estate professional, but we own commercial buildings. And sometimes the year, like, you're going through and you're looking at last year, and the next thing you know, you got an extra $300,000 or $400,000. Like, I'm not trying to, that's just what happens in real estate when you have hundreds of properties. You're off, a couple percent. And you end up like, oh, crap, I'm going to have an extra, $400,000 hit my return. Do I want to pay tax on that? If the answer is no, then we select one of our buildings and cost seg it. We've done that on multiple years where we just said, hey, or you just say, hey, it's not that much, I don't really care. Or I have some carry forward loss from a previous year. You get to make that choice. That's the whole thing, is you're supposed to be the one that's in the driver's seat. You're not supposed to be a victim of these things. All right. The last thing I'm going to go over on the tax side, and we're going to go over a bunch of deductions, but I'm going to go over the wrong entity. This is what I see a lot. And when we can unlock a bunch of deductions by being the right entity. The first thing that you got to understand is that there's really kind of like 3 areas that are involved when you're setting up an entity. The state where we set it up. And now you know that you could pick any state you want. I could set up a Wyoming entity, whether I live in Hawaii or in Florida, it doesn't matter, or in Puerto Rico for that matter. We have to worry about third parties, which might be the bank, a lender, an angel, a lawyer, a judge. We have to worry about how other people are going to perceive our document. That's why we hate things like LegalZoom that are out there, because their documents are crap for most of these purposes. And we're just like, hey, you got to have something that's very specific to you. Let's make sure that we're being specific as to what type of activity, and that we're addressing everything from what happens if you want to change out a manager, is it manager managed, member managed, What happens if somebody dies? What happens if somebody sues? What happens if you get a creditor from the outside? What about distributions? Should we require mandatory capital expenditure? All that stuff needs to be in your operating agreement or your bylaws, whatever your documents are, but we have to worry about third parties and your interaction with third parties. We can't ignore it. And then we have the feds, and this is your tax treatment. So for example, I could set up an LLC with the state, and maybe I'm setting it up specifically because I have a lender who wants to do a portfolio loan. That document's going to look different than if I set up a holding LLC that I didn't have a lender on, because the lender wants to know that if they need to, they can step in and get their property or get your entity. When you're doing portfolio loans, I'll tell you 9 times out of 10, my experience is they set up a special purpose entity and they secure the loan with the shares in that entity or the membership units in that entity, so that if you don't pay, they're not foreclosing on the properties, they're taking the entity that owns the properties. And that way they don't have to deal with a bunch of foreclosures, especially if you have 30 properties. The last thing they want to do is 30 foreclosures. They want to take one entity and be back in charge. That entity looks very different than if I'm worried about, a judge coming after me or somebody trying to sue me. I have to know, is this how it's going to be treated? And then from a tax standpoint, the feds don't care what you are. If I'm an LLC, they just say, tell me how you're taxed. I'm an LLC. And they're going to say, I didn't hear you. How are you taxed? Well, I'm an LLC. And they're going to say, I have no idea what that is. Please tell me how you're taxed. There's no tax form for an LLC for the IRS. They're going to say you're either a sole proprietor, a partnership, a corporation, an S corp, or we're going to look at the owner. We're going to ignore it. Isn't that wild? So like whenever you so if you're like an LLC, the IRS is doing this. Tell me what you are. And they can't hear LLC. They're just going to be like, hey, are you an S corp? You have a bunch of choices. So when you look at the organization, it's helpful to know what it is. Like when we do a land trust for your personal residence, right? The tax form is, this is a grantor trust, which equals it's ignored. It's the grantor. It's you. No difference. A land trust is no different than a living trust, by the way. They're both grantor trusts. Land trust, personal residence trust, living trust, inter vivos trust, they're all the same thing. They're a grantor trust. They're ignored. Sole proprietor. What tax form? It's going to be your Schedule C. It's your 1040 Schedule C. Partnership is going to be a 1065. C Corp at 1120. S Corp 1120S. LLC, you tell me, right? You get to decide. It could be, hey, it's held by a partnership. It's held by a holding company. Okay. Then it's going to be taxed as that holding company. We ignore it. It's called a disregarded LLC. Those are great for real estate. Long term. S corporation, they're great for flips or active businesses, other active businesses. C corporation are great for management entities. Oh my gosh, there's nothing better than a C corp sitting there getting paid from all of your different businesses. Hey, I have a C corp and I get to choose how much I'm going to pay. I'm sitting on both sides of that transaction. How much do I want to charge? How much do I want to pay? And I can use it as a nice depository for making sure I'm at 21% tax. Partnerships are great for holding entities. Something we haven't talked about much today. It's also great for trading entities. What I like to do for those of you guys who are option traders and you know that there's something called a trader status out there, and I can tell you, don't do it. Don't do it. You might as well just audit yourself and they're going to beat you up. The easiest way around that is just to set up a trading account in a partnership. So an LLC taxes a partnership and have a C corp as your partner. Now I can pay the guaranteed payment to partner. I'm not deducting anything. I'm just making sure that I only pay tax on the net and I can do all my expenses. You can't write off those expenses as an individual. Law doesn't allow it. It's kind of silly. So I already gave you guys this one. This is where you look at the different audit rates. But a lot of times people don't look at this. They just go, that somebody says, that's me, I'm an option trader. Yep. So you probably want to be trading your options inside of an LLC taxed as a partnership. And you have a corporation, it might be 10, might be 20% owner. So a bunch of that income is going to flow to the corp, and it's going to use those monies to pay off its expenses. If you need to get more money into the corporation, then you do what's called a guaranteed payment to partner. You might pay it a set amount every month, whether you make money or not. You got to just pay that. And you could do that. Somebody says, is Toby live right now or is he recording? Toby is live right now. You can ask me a question if you want. All right. So when I look at these things, then you just got to ask yourself simple questions. Hey, should I be an S corp or should I be a sole proprietor? It might be as simple as this. Option number one, hey, you're 1,000% more likely to be audited than option number two, and you're going to lose 94 to 95% of the time. Raise your hand if that's what you want, right? Option number two, you're going to be audited once every 500 years. That's on average. And if you are audited, you're going to lose those audits about 62 to 71% of the time. Like, it's not even close. I'm taking option two every time. I don't know why anybody wouldn't. But then it's also how much tax you pay, because here's the actual apples to oranges. I'm going to try to make them apples to apples, right? If I put those two things together and they're taxed wildly differently, but I set up a pizzeria and I make $50,000 a year. After all my expenses, my typical expenses, I'm making 50 grand as a sole proprietor, or I'm making 50 grand. That's my gross profit out of an S corp, and I know I could pay myself a salary. This is what the numbers look like. I will save on 50 grand. I'm going to save myself about $5,000 a year. It's about 10%. That's crazy. The option number two is an S corp right here. Here, I'll make another color. I keep going to these white screens. There we go. So you're looking at an S corp. And I just do a quick comparison. Hey, I need the money. I need to live off of it. Maybe I just do a side-by-side comparison. Here's 100 grand. Same thing. I'm making 100 grand. And I'm adding in all of the Fed taxes. I'm using the standard deductions on both. I'm using a W-2 income of 45,000 out of the S corp. I'm not getting crazy. I could actually pay myself less and and save even more. It's probably going to be closer. If I wanted to be aggressive, I could probably get to about 10 grand in savings, but I'm just being as milquetoast as humanly possible. And I'm still going to save myself close to 8 grand a year. And I get the accountable plan. Like, there's even more deductions. So I'm being as conservative as humanly possible. Here's the two returns sitting side by side, 1 and 2. Which one looks more complicated? Humor me, guys. Put it in chat. Which one looks more complicated, 1 or 2? Or are they the same? You could say same, you could say 1, or you could say 2. Which one looks more complicated? Because this is what's funny. This is a sole proprietorship. This is a corporation, the S corporation. Those are the two tax returns. You have to keep balance sheets on both. It doesn't matter. You got to keep profit and loss on both. I just always, some people say the same. Some people are saying, the vast majority say 2 is more complicated. We have a couple of ones that come in as more complicated, but I mean, it is 27 lines to 31 or 32B, so 33 lines. I don't even care so much about that. What I care about is that the common refrain of people is that, oh, the S corp is way more complicated. And I always look at it going, it's actually the same. Most accountants will tell you an S corp return is really easy to put together. The Schedule C's are a lot more complex. And the reason is because they're not nicely cut away from each other. Like, when you do an S corp, you have your separate bank account, you have records, you have bylaws. It's a vehicle. Most people, when they do a Schedule C, they're just doing it on the cheap. They don't have anything. Usually it's in their name, and they're using the same bank account that they pay their own expenses out of, and it becomes really muddy, really quick. And their record keeping sucks because somebody told them it's easy. You didn't have to do anything. There's not as many formalities as in an S corp. And that's not true. Here's the accountable plan that I told you guys. This is the actual federal reg. So you can just look at it, 26 CFR 1-1.62-2. Amounts treated as paid under an accountable plan are excluded from the employee's gross income. They're not reported as wages or compensation or on the employee's Form W-2 and are exempt from the withholding and payment of employment taxes. Do you get it? You don't have to report it anywhere. Somebody said they wanted to see a cite on that. They're like, where's the cite on that? I'm like, yeah, it's the regs. That's the law. So the regs and the tax code. The regs are the interpretation of the tax code, but it's law. Here's the rub: is you have to be taxed as an S corp, a C corp, or a nonprofit to use an accountable plan. So you could be an LLC taxed as an S corp, an LLC taxed as a C corp, an S corp, or a C corp. Somebody says, but you have to, as an S corp, you have to still file the 1040. So there's prep costs for both. Mary Beth, you're absolutely 100% correct. You have to file a 1040, but the only thing I was pointing out was the two forms. That's Schedule C versus your 1120S. That's the actual return right there. See where it says sign here? The Schedule C is attached to your 1040. The prep is the same. One, you attach to your existing 1040. One, you file as a separate. One, once you attach that to your 1040, rockets your audit rate to 1.6% if you're making 100 grand. Yeah, I don't know. I don't want to sit here and argue about it. We do them. I know what the time requirements are. It's so much easier. Oh, the accountable plan is when an employer reimburses you for expenses that help the employer. So I could reimburse 100% of my cell phone. I could reimburse 100% of my computer. I could reimburse 100% of any business mileage that I do. I could actually reimburse my car if it's all being used for business. There's a huge benefit. But here I'll go over the actual items. You can do business meals. You can do 100% this year, by the way, if you eat at a restaurant. So if you take clients to business meals, 100% reimburse you. If you pay that out of your personal pocket and your business doesn't reimburse you, you can't deduct it. It's a non-reimbursed business expense. It's a miscellaneous expense. It's not allowed on a 1040 any longer since 2017. You can write off education. You can write off any startup and organizational expenses. So for example, if you already had an S corp or a C corp and you bought the package today, more than likely you'd be writing off through there immediately. Travel expenses if you have to leave or you go on a trip or you go to an event. Cell phone expenses, 100%. Data, like it doesn't matter. I'm using it for personal. I only use it 10% for business. It does not matter. Your business can reimburse it. There's case law on this. Computers and equipment, easy, especially if you hire your kids. Hey, you're going to go to college. Guess what you're going to be doing? You're going to be doing some wholesaling, kiddo. You're going to learn PropStream and you're going to start sending out texts. That way I can pay for your computer and write it off. And you're going to write off your cell phone. The internet's 100% deductible if you need to use it. If you need to have, like right here, I'm sitting in my house. I teach these courses directly from my home. I have to have internet. Guess who's writing that off? Right? They can absolutely pay me. And then the employee home office. This is a huge one. I'm going to show you how to write off about a 20% of your house right now. And then if you're a C corp, you can reimburse 100% of your medical, dental, vision, and long-term care, even things that aren't covered by insurance, even if you have an employer plan. So let's say that I have a spouse that works for an employer and they cover me, but I have co-pays and I have deductibles and I have things that my insurance won't cover. My C corp can reimburse 100%. This is especially important to those of you who may have dependents that you're caring for, including parents. If you have medical expenses, this may, like we have clients that pay $20,000, $30,000 a year for loved ones, 100% deductible if we have that C corp and we can make it qualify. All right, let's talk about your house because you guys are setting up. Let's say you set up in Wyoming. Somebody says, does that include supplements? It depends. If you get a doctor's prescription, yes. Otherwise, no. Vitamins tend to not be. There's HSAs too, where you can write off an HSA, which I would strongly recommend anybody do. A health savings account, you can write it off and you never pay tax on any of the growth or the income or that money if it comes out for medical expenses. If you're over 65 and you didn't use it for medical expenses, you just pay tax on it, kind of like an IRA. But you get to, anybody can write that off if you have a high deductible plan that qualifies. You know, so you look at your HSA, you talk to your HR person and say, do I have a high deductible plan? And they'll be able to tell you. All right. So let's talk about an administrative office in your home. So we call it home office, but it's technically, this is an administrative office in your home. Since your entity, especially if you have one in Wyoming, it might be a Wyoming entity. This is where you do the administrative work for that business. It automatically qualifies. Now what we do is we add up all of our indirect expenses in our house. So when I say indirect, it means it's not dealing specifically with the business. So let's say that I set up this room in my house, right? And I had to paint it and I had to get it wired for the internet. So I have $200 and I had to paint it. So I have $600 of direct expense. I can reimburse that 100%. The business can just give that right to me. Here you go. It writes it off. I don't have to recognize that income. But what about my mortgage interest, my real estate taxes, my insurance, my electric, gas, and water, my internet, and my, let's say I have somebody come in once a month and clean the place for $100 a month. Then I have all these expenses and I add those up, but it gets better because the IRS also says, but you have a depreciable basis. So I have the home, and don't worry, you don't have any recapture on this because this is a reimbursement, but you calculate via the IRS's, this is how they tell us to do it. This is their chart. So they say, all right, what year this, you know, I've had this house for 5 years and I put it into service in June. I set up my business. It's 2.564%, which is 10 grand, $10,256. I add up this amount and this amount. So it's going to be right around 30 grand right there. And I add up all my total indirect expenses and I figure out what methodology I want to use. I could use net usable square footage. I could use number of room. I figure it out. The best option for me, I get to choose what's in my best interest, is that 20%. And I reimburse, writing myself a check that is deductible, this extra money. So in this case, it was almost $7,000. Ooh. What about the administration of the accountable plan? That's you, Jenny. You can absolutely do that yourself. An accountable plan just means send me on a, they say reasonable timeline. So I just say quarterly, figure out what your expenses are and reimburse or put it as an IOU. Isn't that crazy? I literally am going to get an extra 7 grand tax free. If I did this as a sole proprietor, my safe harbor is $5 per square foot. In this particular case, I had a 12 by 15 or something like that building, or 10 by 15. So yeah, 150 square feet times 5. So it was a $750 deduction versus 7,000. Let's see, that's a hard one. Which one should I write off? How about the $6,943 one? But that's not it. This gets more fun. Somebody says claiming loss. The CPA says that loss, passive activity in real estate when your W-2 income exceeds 400 and you're not a real estate limit. Is a limit. No, there isn't. There is a loss limitation depending on, oh shoot, but it's a really, really large amount. Then that's not what he's talking about. He's talking about active participation that phases out at 150,000. Real estate professional has no limit. But anyway, sorry, I'm reading questions as they pop up, but I can't resist. I do that at Tax Tuesday, and I just like to do it. The admin office percentage, 100% deductible, but it depends on the amount of your home it's being used. And you can use any reasonable methodology. So you could use the room methodology, you could use net square footage, or you could make one up that sounds reasonable. There isn't a rule. It's any reasonable basis. We know that the room methodology is reasonable because the courts have accepted it. And we know that the net usable square footage is acceptable because the courts have accepted. But that doesn't mean that that's the only way. Any reasonable methodology that you use to determine what is fair, and the way they look at it is your employer, if they were if it was Microsoft reimbursing you, what would they use? In addition to the administrative office, not one or the other, you can also do something called the 280A. This is the Augusta exception. So people were saying, what about the 14-day, I can rent my house to my corporation, not pay any tax? This is that rule. So it's actually 26 USC 280A, and its title sounds horrible, right? Disallowance of certain expenses in connection with the business use of a home, rental, or vacation home. That sounds horrible. But in all things where they take stuff away, this code provision was enacted by Congress to curb the abuse of people saying, I'm using my home for my office, therefore I'm going to write off everything 100%. So they said, hold on here now. What they did spell out quite clearly, and it's under subsection G2, is that if you rent your house out for 14 days or less, so it's actually less than 15 days, which is English for 14 days or less, you don't have to recognize it as income. This is what Airbnb picked up on. And they said to people, hey, rent your house out when you go on vacation and you don't have to pay tax on it. And so they were saying, hey, people, put your houses on our platform. We'll get it rented for you so it can help pay for your vacation. Because on vacation, you're paying for your home, plus you're paying for whatever you're renting. Here, at least, it would be like almost like you're swapping somebody's house. Hey, you live in Hawaii, I'll come stay in your house. You can come stay in my house in Vegas, right? But it gives you a platform to do it. So it says basically no deduction otherwise allowable would be allowed. We don't have to worry about that. That doesn't really matter. What we care about is this: the income derived from the taxpayer doesn't have to include it in their gross income. Any house that you use or any dwelling unit that you used as a residence. So technically you could do, if you have those timeshares, that would actually qualify. If you have two homes, you still only get 14 days on your return, but you could still do it. So there's a lot of little nuances for real estate. And I guess what I really wanted you to do is kind of get a taste for some of the things that are there and understanding that this is tip of the iceberg. There's actually quite a few more. I touched on depreciation. We never even touched on capital gain exclusions and 1031 exchange, how you could actually double that up on a house. Like some of you guys have houses that are worth $2 and $3 million, maybe more. And you have way more than $500,000 a gain when you sell, and you're like, holy crap, I only get $500,000 exception. Well, actually, you could 1031. You just have to convert it into an investment property, and we could show you how to do that. Installment sales, that's section 453 of the Internal Revenue Code, where you're pacing and spreading out a tax hit over multiple years. Step up in basis, what happens when somebody passes, or if you're in a community property state, one spouse passes and your basis just stepped up, you don't even realize it. Buy, borrow, die. That's the Elon Musk. You borrow, you're against your Tesla stock. Borrow billions of dollars, never pay $1 of tax on it if you don't want to. Or Warren Buffett's good at this. A lot of people are good at this. Or if you're a real estate investor, you realize, hey, when a house is appreciated, when all your property is appreciated, a bunch of you guys are going out and refining your houses, taking that cash and buying more. Yeah, you didn't pay any tax on the money you borrowed from your properties, did you? All you have to do is die at some point, and the basis goes up. So somebody, if they have to and sell a property, they'll pay no tax. Income shifting. Hey, let's pay my kids. Let's get money into a management company. Let's put money into a 401k. Let's put money into a DB plan. Let's pay a charity that I control. All those things are just income shifting. There's so much more, guys. We could sit here and talk for days on this stuff. It's absolutely fascinating. And yes, it's in the accountable plan. You can get out, or in the tax toolbox. So the tax toolbox, that's part of the package. There's more in there. There's so many goodies. We just keep jamming it full. I'm just going to keep adding stuff to it. It's kind of fun. Now, we have a few more minutes left. Let's talk about legacy planning. This is really important because, hey, you spend the time to educate yourself and get an understanding of real estate, and you start buying things. And I always equate this to monopoly.